Now, we want to start with stock control levels. Stock control levels. I think we have discussed this. Now, stock control here simply involves determining the best quantity of inventory to do what? To maintain at any one given time in the organization, so that to prevent overstocking and understocking, and at the same time, you minimize costs associated with what? Inventory. We have 4 control levels. The first one in category order level. A reorder level here represents the replenishment level. So basically it means it is the level at which stocks, the level reached, where orders have to be placed with suppliers. Where orders have to be placed with who? Suppliers. It is the replenishment level, and it is given by your maximum usage. Multiply that by a maximum lead time. Multiply that by maximum lead time. Number two, in a total maximum stock level, maximum stock level here simply indicates the level stocks should not be allowed to exceed, to prevent overstocking. So it is given by the order level. That's the reorder quantity. That's minimum lead time. Minimum. This is by minimum lead time. Number 3 is minimum stock level. This simply shows or indicates the level stocks should not fall below to prevent understocking. It is given by the order level minus normal usage by normal lead time. By normal lead time. And the third one is what we refer to as average stock level. Which simply is the average of the maximum and minimum stock level. By what? By 2. You divide that to the maximum and the minimum. You divide that by 2. So I think we can have a question. Let's go to our past papers. Past papers. Let's go to April 2022. Question 2B. April 2022, question 2B. April 2022, question 2B. One of you can you read for us? One of you to some. April 2022.
Mwalimu, I think we had already done that question.
Oh, we had done it already.
Yes,
Oh, sawa.
we stopped there, average stock level.
Oh, this is where we stopped, eh? Sawa. Thank you. So let's talk about reorder quantity. Reorder quantity. Now, reorder quantity here represents the quantity to buy to minimize cost associated with inventory. So it represents the quantity to buy to minimize cost associated with inventory. So the most optimal quantity to order, the most optimal quantity to order, to minimize inventory cost is known as EOQ, is known as economic order quantity. It is known as the economic order quantity. So the EOQ is given by the square root of 2 times your annual demand times your ordering cost per order divided by HC. Divided by HC. B is your annual demand. OC is your ordering cost per order. HC is your holding cost per unit per annum. Holding cost per unit per what? Per annum. Per unit. So we can look at the question together. Go to December, not even before December. Go to November of 2017. November of 2017, question 2A. I'm waiting. I hope umepata hiyo November 2017. So the question states, November 2017 question 2B should be 2B not 2A. BRK Limited orders a material graded X for its manufacturing purpose. The following information is valuable from the production manager. Annual consumption of X is 200,000. Ordering cost per order is 18,750. Carrying cost per unit is 3. Required economic order. So your annual consumption is 200,000. Your ordering cost per order is 18,750. Your carrying cost is known as your holding cost. Inafaa kuwa 3. Inafaa kuwa 3 shillings. So your EOQ is given by the square root of 2 times D times OC divided by AC. Square root of 2 times 1,000 times 18,750 divided by 3. So how much is that? What's the EOQ?
I got 50,000.
50,000. Part 2 of that question is saying the marketing manager intends to reduce this, rather, the number of orders to be placed per year. So number of orders is given by your annual demand by Q, where Q is your reorder quantity. Which in this case is your economic order quantity. So your annual demand is 200,000. Divided by an EOQ of 50,000. That means for you to meet your annual demand, you need to make 4 orders. You need to make 4 orders. Part 3. The 3, the production manager has proposed to increase the current economic order quantity to 100,000 units. Justify how this would increase the total cost of inventory, thus it is not profitable. Now, your total cost is given by your purchase price your purchase cost plus ordering cost plus ordering cost. The purchase cost is normally calculated by P times D. Ordering cost holding cost that is how you calculate those, right? That is how you calculate those. Weird. The purchase price is assumed constant. And it is not affected by the reorder quantity Q. It is not affected by the reorder quantity Q. Hence, it is irrelevant for decision making. Decision making. So therefore, relevant cost will be your ordering cost. Now this holding costs. or the cost price or unit costs. What is price is also known as the cost price or the unit cost. So our cost here So part 3 of that question, the production manager has proposed to increase the current EOQ. What? To 100,000 units. Justify how this would increase the total cost. So, the relevant costs at EOQ, this is where Q is what? At EOQ, you get 50,000 units. Right? So you're going to say your relevant cost will be your annual demand, 200,000, divided by 50,000 times your ordering cost per order was 18,750 plus 50,000 divided by 2 times holding cost of 3 shillings. Times holding cost of 3 shillings. But they are proposing to change the relevant cost or to change and start buying ham units at proposed policy. They want to change that and buy how many units? 100,000. So the question is how many units or that increase, so what will be the change in price? So you will say there is 200,000, which is your annual demand, divide by 100,000 times 18,750 plus 100,000 divided by 2, but your holding cost is how much? 3. So how much is that? How much is that? How much? Give me those total, the relevant cost there.
The first relevant cost I got 82,400.
82,000?
400. The second one I got 153,700.
Now, at the economic order quantity, the holding cost and the holding ordering cost should be equal only at EOQ. At economic order quantity, the ordering and holding cost should be equal. They should be equal. They should be equal. So what this basically means is that if we continue buying 50,000 units, we're going to incur cost of how much? 150,000 shillings. If we change and buy 100,000 units, they're going to incur cost of how much? 187. Therefore, you advise the company's management continue ordering 50,000 units. 50,000 units with a cost savings of 7,500. So if they continue buying 50,000 units and not the 100,000 units, they're going to save 150. They're going to save 37,500. That's nuts. So what we've previously covered is the reorder quantity without discounts. So what you've covered there is the reorder quantity without discounts. Now I want us to talk about the reorder quantity where there is presence of a discount. Ah, So these are the steps you need to follow. Steps. Number one, determine optimal quantity, order quantity Q, without discount, i.e. EOQ. That's step number two. Determine total costs without discount. Total cost without discount. And E, total cost of discount of EOQ. Of EOQ. Q is equal to EOQ, and the reorder quantity and VOQ 3 determine total cost when reorder quantity is the quantity that qualifies for discount. That qualifies for what? Discount. That qualifies for a discount. And the fourth step is your advice to management. Is you advise the what? The management. Those are the steps that you follow. So we have a discount. And this should be total cost. This should be determined total cost when the order quantity is a quantity that qualifies for discount. So I want us to go to a question. Go to December 2021. December of 2021, question 1A. December of 2021, question 1A. One of you do some. One of you kindly tusome your December 2021. Tusome tafadhali. December 2021.
Oh, okay, I'm reading. Question 1A. Distinguish between cost center and cost unit. Limit 2.
tunasubiri tena hii teknolojia ya jioni kwenye vitabu tatapitia.
Mwalimu, is it question 1C ama A?
Question 1A.
1A.
Yes, November.
Okay.
Question 1A.
It reads, distinguish between cost center and a cost unit. Number B, explain the salient features of economic order quantity approach. Then C, Sanitize Company Limited manufactures our products from raw materials which are purchased at 54 shillings per kg. The company incurs a handling cost of 350 shillings and a transport cost of 400 shillings per day. The carrying cost is 0.5 shillings per kg per month. The investment cost in the raw material is 8 shillings per kg. The annual production of the product is 94,500 units, and each kilogram of raw material produced two units of the final product. Required: Roman 1, calculate the economic order quantity. Roman 2, advise how frequently orders should be placed for procurement. Roman 3, if the procurement manager proposes to order on quarterly basis, what discount should be negotiated if the company is not willing to incur extra cost?
Thank you. So, part 1A, they're asking for the EOQ. It's given by the square root of 2 times B times OC divided by 8C, where D is 150,000 components. OC C is 3 shillings per component. So we say the DOQ is 2 times 150,000 times ordering cost 360 divided by 3. Hiyo ni ngapi? How much? How much? We are reading pilot paper. It's okay. The question that is not the pilot paper.
I got 6,000.
50,000 confirm.
6.
So if they buy 56,000 units of components, their cost of inventory will be minimal, but true of that question. And your ordering cost and holding cost of inventory using the EOQ. So the ordering and holding cost is a relevant cost, which is given by A over Q times OC. It's how much is your relevant cost? Census is given me. Correct. This is 18,000. So when they continue buying the EOQ of 6,000 units, they will incur cost of 18,000. Part 3, advise the management whether the discount should be accepted. So this is the order quantity with discount. Now, these are the steps. Step number one is compute your EOQ. Step number one is compute your EOQ. Yes, we have without discount. And tumepata ni ngapi? 6,000 units. Step number two, determine the total cost without discount. So your total cost without discount, the total cost is given by P times D plus D over Q times OC plus Q over 2 times what? It's C. So total cost without discount going to say your purchase price, which is also known as the cost per component, is what? 20 times your annual demand of 150 plus 150,000 divided by your EOQ of 6,000. You multiply by your ordering cost per order. Your ordering cost per order is 360 plus 6,000 divided by 2 times 3. 3. So this I want to believe is 38,000. 18,000. Then step number 4 is you determine the total cost When the reorder quantity is a quantity that qualifies for discount, this is when Q is equal to, which is how much? 6,000. So we want to get the total cost with the discount offer. This is where you reorder quantity. They're saying that the supplier of component X has informed the Blade Limited that it will offer a quantity discount of 1% if an order of 10,000 components or above is made. 10 pounds. So when there is a discount, your purchase price changes. So your new purchase price will be 99% of the current purchase price of 20, which I believe that should be 19.8. Confirm that that is 19.8. Yes, it is. Now, remember, a discount reduces the purchase price. So if the discount is 1%, the new purchase price will be 99% of the current purchase price. All the other items are not changing, therefore, all the other items are not changing. So we'll say, this is 19.8, you multiply by 150,000, that is your purchase cost plus 150,000, divide by 10,000 times 360 plus 10,000 divided by 2 times what? 3 shillings. So how much is that cost? How much is that cost? How much is the total cost?
I got 2,990,400.
2 million.
990,400.
Sawa. The next thing you do is you advance it. So when you calculate that, you must advise them. So when they continue buying the EOQ, they're going to incur a cost of 3,015,000. But when they accept the discount and buy 10,000 units, they're going to incur 2 million. So you're going to tell them, accept the discount. Accept the 1% what? Discount. As it is cheaper. As it is cheaper. As it is what? Cheaper to buy that. About Kosa? Are we together? The second scenario of where you have a discount is under May 2019. Go to May 2019, question 2A. May 2019, question 2A. One of you to read first. One of you read first.
Baraka Distribution Limited purchases and sells a single product branded M. The following information is provided for product M. One, annual demand for the product is 30,000 units. The ordering cost per order is 2,500 shillings. The holding cost is expressed as 20% of the purchase price. A new supplier in the market has presented Baraka Distributors Limited with a proposal for the following range of quantities and respective price per unit. We have range of quantities and price. Range between 1 to 300 is 21. Between 3,000 and 1 to 5,000 is 19 shilling. 5,001 to 7,000 is 17. 7,001 to 9,000 is 5,001 to 7,000 is 19 shillings. 7,001 to 9,000 is 17 shillings. While 9,001 to 10,000 is 13 shilling. Advise the management of Baraka Distributors Limited on the range of quantities to purchase.
All right. Again, by analyzing what you do, then your annual demand is 30,000. The ordering cost per order is 2,500. Your holding cost is expressed as a percentage of your purchase price. So we have different ranges of quantities. So the step number one, determine EOQ. So we have your range quantities. You have your price, P. You want your EOQ. That. So the first range is between 1 and 3,000 units. A purchase price of 21. So your EOQ will be 2 times 30,000 times 2,500. You divide by holding cost, which is 20% of your purchase price. Give me the EOQ. $3,001, 5,000. The price of 19. Two times 20,000 times 2,500. So you're going to get the EOQ for each range, yeah? 70. Give me the EOQs of those items.
The first one I got 5,976.14. The second one, 6,282.81. Then the third one, 6,642.11. The fourth one, 6,956.1. The last one, 7,595.55.
990.
5.
So it's 995. Yeah? Then we determine our total cost. Our total cost will be given by your purchase price. With your annual demand, plus your total ordering cost, plus your total holding cost. So there are certain rules we follow when determining total cost. Total costs for multiple discount offers. For multiple discount offers. Like in this case, what we have previously done is what we refer to as single quantity offer. The previous question of December 2021 and what have you. But this one is multiple discount offer, where different quantities are being purchased for different prices or are being purchased at different prices. So total cost has some certain decision criteria. So you'll have your EOQ, will say if your EOQ is above range, you ignore total cost computation. So don't compute total cost. So if your EOQ is above the range, don't compute total cost. For example, here, with a range of 1 to 3,000 units, your cost is 21 with an EOQ of 59.76. So therefore, because it is above the range, you ignore hapo unaandika nini? Dash. Hapo unaandika dash. Sawa? If your EOQ is within the range, compute total cost, total what? Cost using Q. Using Q as EOQ if it is within the range. If it is, if the EOQ computed is within the range. Within the range, like in our second instance here. So this you're also ignoring because it is above. But now the third instance, it is within the range. It is within the range. And therefore, you're going to say your total cost will be the purchase price of 17 times your annual demand of 30,000 plus 30,000 divided by Q, which is your economic order quantity. We are saying it is within the range. 66.42.11 is within the range. So you're going to divide that by 66.42.11 times your ordering cost. Ordering cost here is 2,500 plus 66.42.11 divided by 2 times 20% of your purchase price, and your purchase price ilikuwa 17. Ilikuwa 17. Ilikuwa 17. Yeah. Right? Now, where your EOQ calculated is below range, compute total cost using Q as least quantity within the range, as least range quantity. For example, here, the EOQ is below the range. So when you're calculating your total cost, you use the least quantity range here, 7,001. So you can call 15.5 by 30,000 plus 30,000 divided by 6956.1. You multiply, not 69 by 7,001. Times 20 times 2,500 plus 7,001 divided by 2 times 20% of 15.5. Ndio? Hii ingine pia useme 13 times 30,000 plus 30,000 divided by, it is below the range, so your least quantity should be 9,001. Yes. That way. So these are the rules that we use when you have multiple discount offers, like in this particular question, like in that particular question. I'm waiting for the answers. How much is the answer for the first, for the government, the 5,000 and 7,000?
$532,583.18. $486,564.31. $410,033.71.
Thank you. Then you advise them. Again, you're going to advise them based on the minimum total cost. You're going to tell them to order between 9,001 and 10,000 units. The reason you're picking 9,000 is because it is the cheapest price. It represents or results to your cheapest cost, results to your cheapest total cost. That way. Si sawa? Kuna swali? Kuna swali? No question. You're going to attempt last this question. December 2023 question 1. December 2023 question 1A. There is a question there on EOQ I want you to attempt. December 2023 question 1 you will attempt there. Then the next concept I want us to introduce is valuation of inventory. So andika hapo valuation of, but before that, let me give you assumptions of EOQ. Assumptions of EOQ. Assumptions of EOQ. Assumptions of EOQ number 1. Number 1. The purchase price per unit is constant. Purchase price per unit is constant. Number 2. The ordering cost per order is constant. Ordering cost per order is constant. Number 3. Holding cost per unit per annum is constant. Holding cost per unit per annum is constant. Holding cost per unit per annum is constant. Number 4. The annual demand is constant. The annual demand is constant and is known. The annual demand is constant and it is known in advance. And it is known in advance. Number 5. There is no minimum stock. There is no minimum stock. There is no minimum stock. Number next, there is no stock out. There is no stock out. There is no stock out. As the demand is known in advance. As the demand is known in advance. Is known in advance. Right. That's that. That's that. So valuation of inventories. Valuation of inventories. Valuation of inventories. These.
Mwalimu.
Yes.
Mwalimu,
Yes, yes.
you said these are the above are
Assumptions of EOQ. Assumptions of economic order
Okay.
quantity. Assumptions of economic order quantity.
noted.
Valuation of inventory is the determination of the average value of inventories received in an organization. A stores ledger card, stores ledger card iko hapa. A stores ledger card is prepared for this purpose. A stores ledger card is prepared for this purpose. For this purpose. A recording of transaction in the stores ledger card. Recording of transaction in the stores ledger card. Recording of transactions in the stores ledger card. Say, stores ledger card transactions, stores ledger card transactions are recorded at the receipt price. Are recorded at the receipt price. At the receipt price, and not the selling price. And not the selling price. The transactions include receipts. The transactions include receipts. Number one is receipts. Receipts are incomings of materials. Receipts include incomings of materials, e.g. purchases, and return inwards. Purchases and return inwards. They are added to the balance. They are added to the balance. Number two, issues. They represent outgoings of inventory or materials. They represent outgoings of materials or inventory. They are valid consistent with the method in use. They are valid consistent with the method in use. And they reduce the balance. They include sales. Return outwards, and stock losses. Sales, return outwards, and stock losses. Number three is balances. Balances they represent the opening and closing balance stock of inventory. They represent the opening and closing stock of inventory. Opening and closing stock of what? Inventory. So what? We're going to pick it up from there in the next lesson. So attempt those questions and send them to me.